Attorney Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the continuation in a LawCast series talking about the NASDAQ listing requirements. All companies that apply for or list on NASDAQ must meet stringent corporate governance standards. The categories of corporate governance include distribution of annual or interim reports, independent director requirements, the requirement to have an audit committee, a compensation committee, and a nomination committee, and the makeup of those committees, codes of conduct, annual meetings, solicitations of proxies, quorum requirements, conflict of interest standards, shareholder approval requirements, and voting right requirements. A company must make its annual and interim reports available to its shareholders either through mail or electronically on the company's website. A company must have a board of directors, and that board of directors must have a majority of independent members. A company is required to have an audit committee consisting solely of independent directors who also satisfy the requirements of SEC Rule 10A-3 and who can read and understand fundamental financial statements. There must be 3 members of an audit committee, or a minimum of 3 members. 1 member of the audit committee must have experience that results in that individual's financial sophistication. A company is required to have a compensation committee, again consisting solely of independent directors. The compensation committee must have a minimum of 2 members. There are additional independence tests and requirements for compensation committee members. The compensation committee must determine or recommend to the full board of directors for determination the compensation of the chief executive officer and all executive officer positions. Company must have a nomination committee, and that nomination committee must be independent and must select or recommend directors for nominee. A company must adopt a code of conduct applicable to all directors, officers, and employees. A company is required to hold an annual meeting of shareholders no later than 1 year from the end of its fiscal year end. The company is required to solicit proxies for all shareholder meetings. Quorum must be set at not less than 33 1/3% of all outstanding shares of its voting stock for any meeting of the holders of its common stock. The company must conduct an appropriate review and oversight of all related party transactions for potential conflict of interest situations. The company is required to obtain shareholder approval for certain issuances of securities, including acquisitions where the issuance equals 20% or more of the pre-transaction outstanding shares, or 5% or more of the pre-transaction outstanding shares where a related party has a 5% or greater interest in the acquisition target. Issuances resulting in a change of control, equity compensation issuances, and private placements where the issuance equals 20% or more of the pre-transaction outstanding shares at a price less than the greater of book or market value. Finally, corporate actions or issuances cannot disparately reduce or restrict the voting rights of existing shareholders. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance and producer of LawCast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.